When you deposit $1,000 at your bank, they're legally allowed to lend out $9,000 they don't actually have. This isn't a conspiracy theory. It's not illegal. It's exactly how the banking system is designed to work. And it's the reason every major financial crisis in modern history has happened. Right now, as you're watching this video, banks across America are creating money that doesn't exist. Not printing it, not earning it, just creating it with accounting tricks and a few keyboard strokes. And here's the disturbing part. Most people, including people who work at banks, don't actually understand how this system works. But once you see it, you can't unsee it. So let me show you exactly what's happening with your money. Let's start with a simple example. You work hard for 2 weeks and earn $1,000. You deposit that money into your checking account at Bank of America, Chase, Wells Fargo, doesn't matter which one. You check your balance. It says $1,000. Everything looks normal. But here's what you don't see. The moment your deposit clears, your bank doesn't just hold on to that money. They're required by law to keep only a fraction of it in reserve, historically around 10%. So they keep $100 of your deposit. And the other $900? They immediately lend it out to someone else. A business loan, a mortgage, a car loan. Now here's where it gets weird. That person who borrowed your $900 doesn't take cash and hide it under their mattress. They deposit it into their bank account, which means that bank now has a $900 deposit. And guess what they do? They keep 10%, which is $90, and lend out the other $810. That $810 gets deposited somewhere else. That bank keeps $81 and lends out $729. This cycle continues over and over. By the time this chain is finished, your original $1,000 has created nearly $9,000 in loans throughout the banking system. $9,000 from $1,000. This is called fractional reserve banking, and it's not a glitch in the system. It is the system. Banks don't lend out money they have. They lend out money they create through this multiplication process. Now you might be thinking, wait, if I deposited $1,000, how can the bank lend out $9,000 total? Where does that extra $8,000 come from? Here's the truth that makes economists uncomfortable. It comes from nowhere. It's created the moment the loan is made. When a bank approves your mortgage, they don't go into a vault and pull out someone else's deposits. They simply type numbers into a computer. Your loan balance appears, and just like that, new money exists in the economy. The Bank of England, one of the oldest central banks in the world, admitted this openly in a 2014 report. They said, and I quote, "Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits." Read that again. Loans create deposits, not the other way around. So why does this system exist? The idea was actually kind of brilliant when it started. Centuries ago, goldsmiths noticed something interesting. When people deposited gold with them for safekeeping, not everyone came to withdraw it at the same time. So goldsmiths started issuing more receipts than they had gold in their vaults. As long as everyone didn't ask for their gold back simultaneously, it worked. And it kept working. This system evolved into modern banking. The logic is this: if banks can lend out more money than they hold, it stimulates the economy. Businesses can expand, families can buy homes, growth happens faster. And when things are going well, this system seems like magic. But here's the problem. This entire structure is built on one massive assumption: that everyone won't want their money back at the same time. It's a confidence game. As long as people believe their money is safe, the system holds. But the moment that confidence cracks, everything falls apart. And we've seen this happen over and over. Think about 2008. Washington Mutual, the largest savings and loan in America, collapsed in 10 days. Not because they made zero money, not because their buildings burned down, but because word spread that they might be in trouble. Customers rushed to withdraw their deposits, and because the bank only held a fraction of those deposits in reserve, they couldn't give everyone their money back. The bank failed. Customers lost access to their accounts. Thousands of employees lost their jobs. And this is the thing that should make you angry. The money those customers thought was sitting safely in their accounts, it didn't exist. It had been lent out, multiplied through the fractional reserve system, and turned into mortgages and loans that were now failing. Now, imagine you're a family living paycheck to paycheck. You have $3,000 in your checking account. Rent is due in 3 days. Then you hear your bank might be in trouble. You rush to withdraw your money, and there's a line around the block. Everyone had the same idea. The ATM runs out of cash. The bank's website crashes. You can see your balance on the screen, but you can't access it because it's really not there. This isn't a hypothetical. This happened to real people in 2008, and in 1929, and in 1873, and it will happen again. Here's the bigger picture most people don't see. This system doesn't just create money, it creates debt. Every dollar in your bank account exists because someone, somewhere, went into debt to create it. That's not an exaggeration. In a fractional reserve system, nearly all money is loaned into existence, which means the total amount of debt in the system will always be greater than the total amount of money available to pay it back. Think about that. It's mathematically impossible for everyone to pay off their debts at the same time. The system requires constant growth, constant borrowing, and constant money creation just to stay stable. And when that growth stops, defaults happen, banks fail, recessions begin. Oh, and here's the kicker. In March 2020, the Federal Reserve reduced the reserve requirement to 0%. Zero. That means banks are no longer required to keep any of your deposit in reserve. They can lend out 100% of it and then create even more money on top of that through the same multiplication process. The rules that were supposed to act as a safety net, they're gone. So the next time you check your bank balance, remember this. That number on the screen isn't money sitting in a vault with your name on it. It's a promise. A promise that if you want your money, the bank will find a way to give it to you. And as long as not too many people ask at once, that promise holds. But the system we trust with our savings, our mortgages, our entire financial lives is built on a foundation that's far more fragile than most people realize. Banks create money out of thin air. They always have. And until we understand that, we'll keep acting surprised every time the whole thing comes crashing down. The question isn't if it will happen again, it's when.